Hi friends, today we are going to discuss about very good terminologies that we frequently hear in news from RBI, repo rate, reverse repo rate. Also we will look at CRR, SLR. So what is this CRR? CRR means cash reserve ratio. Let's say for example you have RBI which controls the banks, and then you have a bank, and then you have customers. So now let us look at an example. For example, customer is depositing 100 rupees in the bank. So now what banks will do, they can invest that money or they can give it for higher interest to the people, customers. But here RBI decides, for example, CRR, cash reserve ratio, as 7%, which means bank cannot use this entire 100 rupees. They have to first deposit 7 rupees in RBI, and then remaining 93 rupees can be used by bank for various other purposes. So this 7% is called cash reserve ratio. So now let us look at what is SLR. SLR is statutory liquid ratio. Let's say for example, now you have bank has 93 rupees. So this 93 rupees bank cannot give it to customer complete amount for interest or any other purposes. So now what bank should do is, for example, if RBI decides SLR percentage is around 25%, now 25% of the amount should be invested in liquid assets. Liquid assets means maybe government bonds or gold. So they have to invest in this and they can earn interest on this. And remaining 75% amount can be either used for their expenses or give for interest rates for customers. So this is called SLR. So now what is repo rate? So we frequently hear this from news channels when RBI announces. So repo rate means, let's say now for example bank doesn't have money. So what they will do, they will go to RBI and they will take money for interest. Let's say if RBI decides repo rate as 6%, so bank can go and take from RBI for at the rate of 6% interest. And what they do by taking this money, they will again give it to customers for higher interest rate. So what happens when RBI increases repo rate, bank also increases interest rate, and this is controlled by individual banks, but repo rate is controlled by RBI. And now for example, if bank has excess money, so what they do, they will give the amount to RBI and then RBI will pay interest rate to them. That is called reverse repo rate. So let's say RBI decides 5%, then RBI pays 5% interest rate to banks if they have excess money and invest in RBI. So if it is long term, they may give 5%, and if it is short term, they may reduce to 4%. So this is all about CRR, SLR, repo rate, reverse repo rate. Thanks for watching. Like, share and subscribe, and press bell icon if you want to watch my latest videos. Thank you.